Welcome back, everyone. Today on the Joseph Carlson Show. Now that we've made it through the tariff battle between Mexico and Canada, the war that raged on for approximately 15 minutes, we can finally turn our attention to earnings week. And we have some big important companies reporting earnings this week. In fact, we've already had some big companies report earnings. Palantir reported, and their earnings was incredible. I'm going to go over it. We'll take a look at both the fundamental developments of the company and just a few comments about the valuation. Then, of course, we're going to be looking at Spotify. They reported earnings. It was great. The stock is doing phenomenal, but we have more to come. This entire week is full of earnings. After market close today, we have Google and AMD reporting, as well as Chipotle. We have to see how the burrito bowls are doing. We have Disney Wednesday before market open. Then we have Uber, another company that I'm bullish on. I really do like Uber. I'll be giving some thoughts on that one. And then we have Amazon, Thursday after market close. That's going to be a big one. Now we're going to be going through each of them, discussing what to expect, what Wall Street and analysts are expecting, and what I think are the most important things to pay attention to for these companies going into earnings, as well as my predictions on these different companies. So we have a lot to get into. Let's go ahead and start off. Now we can start off by looking at Palantir. They just reported earnings yesterday, and obviously the earnings were great because Palantir is now trading up 22%, above $100 per share. We have a note here from Qualtrim saying that they beat on their better than expected report. They had strong financial 2025 guidance, and multiple analysts are raising their price targets on the stock. So everything seems really good with this report. With Palantir, there's two parts to this stock. There's the fundamentals and there's the valuation. Fundamentally, this is a great company. Palantir is growing really, really fast. 36% revenue growth year over year is super fast, and there's only a couple companies in the market growing this quickly. So they have this premium growth rate. When we look at the amount of customers, a KPI we track on Qualtrim, this is the amount of US customer count. And you can look at it. It grew 72% year over year. This is every single quarter. Now they're up to 382. So they're gaining in revenue. They're gaining in customers. I like what I see. The free cash flow came in this quarter at $415 million. Now, when we look at this on a trailing basis, we can see a couple different things that don't look quite as good. For example, if we look at the free cash flow, we look at the stock-based comp, it doesn't look quite as pretty. There's a lot of stock-based comp, but investors don't pay too much attention to that, especially when a company's growing its free cash flow as quickly as Palantir is. Overall, I really do like the fundamentals of this company. The only complaints I'd have is that the company does still do a lot of dilution. They're issuing a lot of shares. They're increasing the share count 7%. Now, that's not a problem when the shares are super expensive. In most cases, issuing shares is a problem and it destroys intrinsic value. In this case, they're getting compensated quite well for issuing these shares. So overall, again, I think the fundamentals of this company is great. Palantir is on the right track. Now let's look at the valuation. And I want to zoom in on this. Let's go ahead and zoom in. Let's see if we can zoom in even more here to just take a clear look at the valuation. Can you see it right there? Let's just take a look at some of the numbers here. The market cap is $244 billion. That's really big. That's a huge company, $244 billion. The PE ratio on a trailing basis is 526. On a next 12 months basis, so 2025, it's at 224. And on 2026's estimates, so all of next calendar year, it's at 195 or 192.5. So the PE ratio is way out there. It is in the extreme category. Now, I'll say with PE ratios, I give a little bit of leeway here. I'm not so concerned about PE ratios because I've looked at the chart of Amazon going way back and Netflix, and at different points in time, they also looked very expensive on a forward PE ratio. Amazon looked like it was like a 400 PE ratio at one point in time because Amazon never made any profits, right? So companies that are scaling up and growing quickly can look expensive certain time periods. The number that I'm more concerned about, the one that I think is more interesting out of these valuation metrics, out of the PE ratios, the enterprise value to EBITDA, even the free cash flow yield, the one that I'm the most concerned about is the price to sales. We have an 85 price to sales. It's just astonishing. That is an astonishing price to sales. That's 85 years of revenue to pay for the market cap of revenue, not earnings, which you can increase operating leverage and increase margins to make the earnings go up quickly. That's just pure revenue. 85 times, 85 years worth of revenue. When we look at that and we compare it to other companies, we can type in some of the most extreme valuation companies like CrowdStrike, right? CrowdStrike, that's one that's trading up in the atmosphere. That's an expensive one. It's at 26. It's not even half. It's not even close to half. It's like a third of what Palantir is. We can look at other companies. For example, Dan Ives keeps comparing Palantir to Salesforce. We can look at Salesforce here, and that has a price to sales of 8. So you go from 80 to 8. Salesforce is 10 times cheaper on a price to sales basis. Now, in terms of market cap, Palantir is also almost 80% of the market cap of Salesforce while doing around 10 to 12% of the revenue. So Palantir may be the next Salesforce. It might actually be, but it's priced as though it is a Salesforce today. Palantir is doing $2.87 billion in revenue in the trailing 12 months. If we look at Salesforce's, their revenue in the trailing 12 months is $37 billion. So yes, it's true that Salesforce is growing slower. It's growing at 9 to 10%, but Salesforce is 10 times the size. The growth is going to slow at some point with Palantir, right? Is it going to be 10 times the size and still growing at 30%? That's hard to imagine. So look, if you bought some Palantir at a lower price and you're letting it ride, I completely understand that. I totally get it. I do that with some of my stocks as well. But I don't know who's waking up this morning and buying more of Palantir today. To me, that seems really risky. It's just difficult to imagine that. This company has great fundamentals, but it's already priced as a massive corporation when it's only in the growth phase. And typically companies priced with this level of price to sales haven't done well over the next 5 to 10 years, but we'll have to wait and see. Maybe Palantir will be the exception. Now, next we have Spotify. They just reported their earnings. Spotify's doing great. This is a company that I really love. And if I'm being honest here, it's one of the ones that I feel a little bit of regret selling out of. At the time, I just thought that Netflix was less risky. It was more predictable. I had a really strong feeling that Netflix was going to be a good bet. Spotify, I was just a bit unsure, so I put my money in Netflix. So it worked out okay, but Spotify's done so well. It's really just been an incredible stock. And this quarter was more of the same. Organic user growth, they had high retention rate, they're growing in their freemium and premium, they're growing across the board. And Spotify now is generating real profits. The big question for this company is if they actually have any operating leverage. They've answered that question. They do. So I consider Spotify a decent company right now. In terms of the valuation, Spotify now trades at a premium valuation. It trades in the high 60s PE ratio, price to sales of 7.5, but it is posting now real cash flows. And I think the company still has more to go. If I was to guess, I think momentum's going to continue to carry this one. Now today still, we also have some big earnings reports, the biggest of which is Google. Google's reporting after market close. And this is going to be a big one for me because I own a lot of Google. If we look at my passive income portfolio, we have it here in the tech category. We have Google right here as a $54,000 position, $9,000 in the green. And if we switch over to the story fund, we also have Google in this portfolio as well. Google's another $51,000 position, $23,000 in the green. So across both portfolios, this is a very meaningful company. If we bring up Google on Qualtrim, the calendar here, and this is something you get access to if you join the Patreon, it comes with Qualtrim, it comes with the calendar, it comes with insights and all these tools, and there's a free trial for the rest of the month. So try it out if you haven't already. But on the calendar, we can see the history of earnings for this company. We can look at the estimates. In most cases, Google does outperform, and I believe they're going to once again today. Because Meta posted really strong results, Google should too. So my expectation is they're going to outperform. They've done so for the past couple of years. They had a poor streak here, but they've gotten past that. I'd be surprised if they didn't beat on both earnings and revenue this quarter. When we look at the key things to watch for going into this quarter, it outlines 5 different things. I've highlighted that Google Cloud is one of the most significant parts of the company. In my opinion, it's the bright spot with Google. It's the best part of the business right now. YouTube is an important aspect, but it's not growing nearly as fast as the cloud. We have AI advancements in search, the rollout of AI overviews across multiple new countries, and its impact on search engagement. This is where there's a lot of concern about Google. Are they staying on top of the AI game? Is their search engine still relevant? Or are they going to be surpassed by all these mini LLMs? In my opinion, I think the need to access data is greater than ever. Google knows this, and I think they're positioned really well. I'm guessing that the search business is going to increase its revenue and increase its profits. Even with all these competitors existing, I think it's still going to grow at a brisk pace. Then finally, what I believe is an underrated part of Google is the autonomous vehicle progress with Waymo. Waymo continues to expand to different cities. They're now testing out multiple cities at a time. Their rides have gone from 20,000 a week to 50,000 to 100 to 150,000 per week to now 175,000 per week. I would not be surprised if they said that they're now doing above 200,000 a week. They're going to continue to expand. Fundamentally, Google looks in a really good position right now. In terms of valuation, we have a trailing PE ratio of a 27, a forward PE ratio over the next 12 months of a 23, and on 2026's estimates, it's at a 20. So no matter what way you look at this, if it's historical or forward-looking, the company is pretty inexpensive right now. The price to sales is 7.4. The free cash flow yield is a little bit lower than usual for Google, but that's because they're busy putting a lot of money into CapEx right now, and I consider that a high return investment. I think that the CapEx they're spending on cloud and infrastructure has a predictably high return. I was buying into Google heavily when it was around 170, and it's up around 20% since then, but even at a price of 206, I still think the risk reward is positive for this company. So I'm bullish going into this earnings. Now, at the same time, we have AMD reporting their earnings. They're another company that has done pretty well over the past couple years with beating their estimates. So odds are they're going to beat unless something really goes wrong on both their earnings per share and their revenue. AMD's AI strategy is showing significant promise with data center GPU revenue ramping up as major clients like Microsoft and Meta increase their adoption. So bigger companies are becoming more attracted to AMD. Now, most of this revenue is going to go to NVIDIA as the leader in having the whole ecosystem, but AMD is making a play for this market, and they don't need to win the entire market for this to be a successful investment. AMD is a fraction of the size of NVIDIA, and it's showing good promise with the developments they're doing. They just need to keep showing progress. If they can do that in this earnings report, the stock is going to go up. So I think in most cases, this is going to be one where the stock goes up after, but I'm not going to be shocked if it doesn't because this one's a bit more volatile. Now, next, at the same time, we have Chipotle also reporting their earnings after market close. And this is one that usually does really well. They almost always beat. I've owned Chipotle. I owned it for just over a year. I made around $13,000 on it. So it was a great position, a great company. I sold it because of valuation concerns. But overall, I think Chipotle is a winner. This is a long-term winner. When we look at Chipotle and we have the highlight of what the most important thing to pay attention to is, I think by far it's the number one thing highlighted here. The focus on new store openings and expansion. This is the story of Chipotle, an expansion and growth story. And this is what you want in quick service restaurants. You want new locations, more foot traffic per location, more revenue per location, price increases per location, and more locations. All of that combined amounts to huge revenue increases. With Chipotle, investors should closely monitor Chipotle's plan to expand its footprint, particularly with the goal of reaching 7,000 restaurants in North America. In the last quarter, the company opened 86 new restaurants, including 73 Chipotlanes, and is planning to open 315 to 345 new restaurants in 2025. So they have massive growth and expansion plans. Expansion in the international markets like Canada, Europe, Dubai demonstrates growth potential, with the Canada market already showing strong unit level economics comparable to the US. So even in Canada, people like Chipotle, which of course they would. When we look at this, we can see the growth of their locations over time. This is Chipotle locations. This is growing 8 to 9% per year. That's really strong for a restaurant, especially at their scale. And then not only are they growing in the number of locations, remember we also want to see per location revenue growth. And that's what this chart resembles. It went down during their whole food poisoning scare, but ever since then, it's continually grown while they've increased the number of locations. Now they're making over $3 million per location. That's a huge landmark. They want to get this up to like $6 million with 7,000 locations. The valuation has come down a bit for Chipotle as the stock has gone down a little bit and the earnings have grown. So now we have a company with a 44 forward PE ratio in the next 12 months and 37 over 2026. I think that this is a reasonable price for the company. I think Chipotle is back to a fair value position. It's not a steal, but it's a reasonable price. And this is one that I could jump into if it sells off big time. If it goes down $10 or $15 per share, I'll probably be buying this stock. So this is one that I really like the story. I think the valuation is fine. I look forward to Chipotle's earnings. Now, at the same time, we have another big company reporting earnings, which is FICO. This thing is a compounding machine through and through. When we take a deeper look at FICO's valuation, this is the part that's difficult for new investors wanting to jump into it, is you have to grapple with this valuation of a 58 forward PE ratio, a 49 PE ratio on 2026's earnings. So you're looking out quite a bit to be able to rationalize buying this company. The price to sales is 25, which is also not cheap. So overall, it looks very expensive right now. In order for FICO to justify this valuation, they need to keep growing quickly. They're doing that with their revenue growing at 13 to 15% per year, but they're also doing it with their free cash flow, buying back shares and growing free cash flow quickly because of these price increases. Every price increase they do is so accretive to the company's financials because it basically all drops to the bottom line. So they increase prices by 30, 40, 50%. All of that money is profit that's returned back to the shareholder. When you look at the free cash flow per share, it's grown 32%. Look at this number right here, 32% year over year. That's on a trailing basis. So we're seeing a company that has incredible rates of growth. That's what kept the stock up. You can see the stock is selling down a little bit year to date. I don't think that's a big deal or even necessarily a big dip at this point because it's still up 45% over the trailing year. So FICO's done just fine. If this trend of it continuing to go down happens and it keeps going down for an extended period of time, I'm going to take a closer look at this one. I'd love to own FICO, but the high valuation has kept me out of it. Now, moving on to Wednesday before market open, we have a couple big companies reporting earnings, Disney and Uber, both of these of which I'm very interested in. Disney's a company that I think has a lot of good things going for it, but if I had one complaint about this company, the thing that keeps me out of it is just the sheer complexity of the business. For example, when we bring up what to watch for here, it does highlight really what's going on with the context of the business and all the things they're concerned about. They have content and creative growth, streaming strategy and subscriber growth across all different streaming categories. Disney's kind of a mixture of like a Netflix-like streaming business, but also they have Hulu. Also, they have cable television. It's all a mix. You have the strength in live sports and ESPN developments. You have parks and experience expansion. You have international market opportunities. There's a lot going on with Disney, and even though I think the company, generally speaking, is headed in the right direction, the complexity of this business is one of the biggest problems. Now, when we look at the valuation of Disney, it trades at a low valuation, 20 forward PE ratio, 18 forward PE on next year's earnings. That's not expensive. Looking at the free cash flow yield, it's 4%, 3.5% if you want to factor in stock-based comp. That's also not expensive. So I don't think there's as much downside with owning Disney right here or buying it right here. I think you have limited downside risk, but I also don't think it's going to have explosive upside. Maybe I could be proven wrong, but I just don't see that in the future. Now, as Disney's reporting on Wednesday before market open, we also have Uber. This is a company where their earnings are all over the place. Historically speaking, it's a coin toss of whether or not they beat on their earnings per share estimate. But I believe that it's more predictable now than it was over the past couple of years. During these time periods where they missed, they were unprofitable. There's a lot more factors working against them, and I believe the business has become far more profitable and more predictable. So if I had a guess on these earnings, I think they're going to beat on the top and bottom line. Really, when we look at all of the possible concerns with Uber, the reason that this company trades at such a cheap valuation, it all comes down to this fifth point. Focus on autonomous vehicle partnerships. That's the most important storyline for Uber going forward. Uber's autonomous strategy, which involves partnering with 14 AV companies, including significant expansions with Waymo in Austin and Atlanta, is key area of interest. Investors should monitor the impact of these partnerships and the potential to contribute to Uber's growth and operational efficiency in the coming years. So we should be focusing on the partnership with other AV companies. I like what I see so far. Uber has been partnering with Waymo and with other companies as well. And I believe they're going to continue doing this aggressively to become a consolidator, to make it so that there's only a few one-off companies like Tesla trying to directly compete with them. So the combination of a cheap valuation and fast growth has attracted a lot of investors. And I think that in most scenarios, they're going to be proven correct. I think it's most likely that Uber is going to be a great investment. Maybe 9 out of 10 scenarios this will work out. But there is this one scenario where Uber's profit margins are pressured, where the company loses significant market share because of AV companies like Tesla and Waymo. If those companies decide not to partner with Uber, if they just run their own business and they start to proliferate and gain market share, that could put downward pressure on this company. So that's the one reason I'm not invested in it, is just in case that happens. I like investing in companies where I have a very high degree of certainty that the long-term terminal value is going to play out. With Uber, there is some scenarios that I'm concerned about. But again, I think in most cases, this one's going to be fine. Now, after Uber, we jump to Thursday. After market close, we have the big one of the week. In my opinion, this is the most important earnings of the week, which is Amazon. Now, before we jump into the numbers here and what to watch for, I just have to highlight my position in Amazon. This is a big one. This is an important one. I'm in it. I'm in it with you guys. I'm crossing my fingers. I'm hoping for the best with this one. Amazon is a $102,000 position, currently $44,000 in the green. So it's grown a lot. It's done well so far. The only position that's slightly larger is Netflix. When we look at Amazon and what to expect, first of all, the expectations I have going into this earnings is I think they'll be on the top and bottom line. I think Jassy's going to pull through. I really do. I think that he's really on track with the earnings, with the profits. He knows what investors want. They want to see operating leverage. They want to see strong growth in all the different segments of the business. And they want to see margin expansion. So if I have to guess this quarter, I think it's going to be an earnings per share beat and a revenue beat. Now, the one that I think is a little bit more out of Andy Jassy's control is the revenue. So I think if there was a miss, it's more than likely to be on the revenue. But again, there's no way to say this for certain. Now, when I blow up the what to watch for here, I really think this does a good job summarizing the biggest points going into Amazon. Continued growth in AWS and the AI business. This is always the top metric that everyone looks for. And I think they've been conditioned to do this. Investors have been told for years, AWS is really just Amazon. Amazon is AWS. It's like the only important part of the business. And that's just not true. Amazon Web Services is great. It's a profitable, great part of the business, but there's far more opportunity right now with other segments of the company. Now, with Amazon's AWS and AI business, again, this is what investors are going to be paying attention to the most. So if Amazon comes in with a slower expected growth rate, it's going to go down. It'll be like Microsoft. Microsoft came in with Azure a little slower than expected, and that caused the stock to go down 4 or 5%. So that could happen with Amazon. I happen to believe that AWS will be strong. I think it's going to continue growing. It won't grow as fast as Azure and Google Cloud because it's much larger. And the larger you are, the more difficult it is to continue growing at those speeds. But the scale of AWS is massive. It's now doing $110 billion in annualized run rate. So this is already an insanely huge business. Attention should be paid to whether the momentum continues, especially with the growing AI business, described as a multi-billion-dollar opportunity growing at triple-digit rates. Investors should track how AWS expands and manages its infrastructure, particularly with new AI capabilities driving higher demand and associated capital investments. Now, in terms of the AI wars, the cloud business, the LLMs, I've looked at Amazon and the cloud business as one of the companies that wins no matter who the winner is. They are predictable winners of the AI battle because no matter which businesses across the US end up using AI and implementing it into their applications, they need it hosted and they need the compute to run it. So it's an aggregator of demand of all the AI opportunity out there. It's one of the big three, and it's the biggest of the three. I love the AWS business. I think it's going to come in with very high margins. I think they'll have commentary on how they're expanding quickly, they're reinvesting, how there's going to be some CapEx spend. I think that Andy Jassy is going to talk a lot on the call about all the AI developments they're doing. They're going to be on top of that. Amazon has a ton of employees at AWS building out massive infrastructure and tools for it. So this is not a part that I'm concerned about. And again, even though this is the largest focus for most investors, this is not going to be my biggest focus this quarter. If we look at number 2, I actually believe that this storyline is becoming more important than the AWS storyline. The impact of cost reduction and efficiency initiatives. Amazon has been focused on lowering costs to serve through initiatives like enhancing inventory placement and deployment automation and fulfillment centers. These changes led to a 25% improvement in fulfillment processing time and are expected to reduce operating costs further. Investors should look for continued improvement in operating margins. Now, the reason that I believe the story of efficiency is more important to pay attention to than even AWS is because of the sheer size and numbers involved here. For example, if we can just illustrate this here for a minute, if we break down the different segments of Amazon, we know that AWS is big. It's a $110 billion run rate, but if we look at that compared to the retail business, we can cross out everything but the first-party online sales, which is the retail business, the third-party seller services, which is also the retail business, and we compare that to AWS. We have the numbers right here. The retail businesses combined make up for around $400 billion of revenue. AWS makes up for $100 billion. So the retail businesses are 4 times the size in total revenue, meaning that a change in profit margin by 1% on the retail segment has the same impact as a 4% change in profit margin on AWS. So it has a disproportionately huge impact because of the sheer size. And I believe they can increase the profit margins of the retail segment, in part through stuff like this: advancements and opportunities in robotics and automation. Amazon's introduction of new robotic augmented fulfillment center designs signal potential for significant cost savings and faster delivery capabilities. These enhancements are already underway. They note that in Louisiana, they have them already. The aim is to reduce fulfillment processing time and improve cost efficiency during peak periods. Investors should watch for the advancements in these areas and consider the impact on operational effectiveness and profitability. If Amazon can bring in all these robots, implement AI in them, and make all their fulfillment centers far more efficient and need fewer human employees, the profit margins of this business could explode. And that would have huge operating leverage on that $400 billion of revenue. There's a lot of story left in this stock, a lot of potential, a lot of growth and optionality, a lot of things Amazon can do. The story is not over for Amazon, and I think it's going to continue for quite some time. And Amazon's in a very advantageous position. It's basically 4 different businesses combined into one. The biggest online retailer, the 3rd biggest advertising company in the world, behind Google and Meta. It's the 1st biggest hyperscaler and cloud hosting company, above Microsoft Azure and Google Cloud. And it's the 2nd biggest streaming company in the world with Amazon Prime Video. Each one of these are significant and great businesses, and they're always trying to grow more. They always have more initiatives. So the company has ample opportunity, it has optionality, it has a lot of growth potential. And in terms of the shorthand valuation and the forward-looking multiples, I don't consider Amazon to be expensive right now. It trades at a 38 forward PE ratio, which again, Amazon can grow earnings very quickly, so I don't consider that too expensive of a company right now. The free cash flow yield is low on a trailing basis, only a 1.7% yield. When you factor in the huge amount of stock-based comp they do, it's 0.77%. If we look at this over time, it really illustrates the insane level of operating leverage this company has. The free cash flow can swing wildly to the positive or negative, and right now, it's going positive. And I think this trend is going to continue. Right now, it's topped out at around $50 billion. I think it's going to $70 billion and above over the next year or so. Amazon's up 10% this year. It's up 45% over the past trailing year. It's up even more in 2023. But even so, I still think the company is undervalued today. I hope you enjoyed the overview. And if you want to see more of it, you can check out the Patreon in the linked comment below. Other than that, I'll see you in the next one.